Deanna, your host. Welcome to Understanding Credit Reports and Credit Scores. During this podcast, we'll cover three major topics. First, we'll examine credit reports, what they include and how they work. Next, we'll discuss credit scores, what they are and how they're calculated. And finally, we'll explore ways to maintain and improve your credit rating. So let's get started. Your personal credit rating can affect your life in many ways. It can influence your ability to pay for college, purchase a car, rent or buy a home, and in some cases, even get a job. Your credit rating is based upon your credit report. This written record serves as a summary of your financial reliability because it documents your history of paying debts and other bills. Your credit report contains several types of information that have been gathered from different sources by one of the three major credit reporting companies, Equifax, Experian, or TransUnion. Each credit report includes identifying information that documents who you are, such as your full name, social security number, date of birth, place of employment, and street address. It also lists information about your past and present accounts. Entries in this area typically show when you opened accounts, your current balance, your highest balance, and how regularly you make payments. Finally, the report contains information derived from public records. It discloses any liens or financial judgments that have been brought against you due to unpaid bills and if you've declared bankruptcy. Now, I'll bet you're wondering, how long does this info stay on my credit report? That depends. Accounts that are in good standing may stay there indefinitely, while most negative items, such as late payments, delinquencies, collections, charge-offs, repossessions, judgments, and Chapter 13 bankruptcy generally lasts for 7 years. Chapter 7 bankruptcy stays longer. It's on your record for 10 years, and tax liens that are left unpaid remain indefinitely. As you can see, your credit report contains extremely important personal information. Fortunately, the Fair Credit Reporting Act, or FCRA, helps protect this information. This law states that an organization must have a legitimate reason to view your credit report. For example, employers in select industries may check your credit report before making a decision about hiring, promoting, or providing security clearance to you. Landlords may likewise consider it before renting to you. Prospective lenders may review it before they approve or deny credit or to help them decide what terms to offer. And insurance agencies may use it to help determine the pricing for your policy premiums on home, auto, or life insurance. Credit reports also may be requested by current creditors who are monitoring your account or in response to court orders or federal jury subpoenas. When your credit report is requested because you've applied for a loan, credit card, or service, this is listed on your credit report as a hard pull inquiry. The more hard pull inquiries that show up there, the less favorably it affects your credit score. However, when several inquiries are made by mortgage or car loan providers within a short time, this normally counts as one hard pull. Hard pull inquiries usually stay on your credit report for 2 years. When an employer or current or potential lender makes a behind-the-scenes inquiry, this is known as a soft pull. It doesn't show up on credit grantors' copies of your credit report or affect your credit score in any way. This is also true when you request a copy of your credit report yourself. It's wise to regularly request and review your credit reports to make sure they're accurate. The FCRA requires each of the nationwide credit reporting companies to provide you with one free copy of your credit report every 12 months. To request and receive a free immediate copy from Equifax, Experian, or TransUnion, go to www.annualcreditreport.com. This is the only website that's authorized to perform this service. You may order 1, 2, or all 3 reports at the same time, or you may spread out your requests. Credit reports from the 3 major companies generally contain similar information, So some financial advisors recommend staggering your requests throughout the year so you can keep a closer eye on how accurate they are. Credit reporting companies and the entities that provide them with information are legally responsible for correcting inaccurate or incomplete information on credit reports. Under the law, you have the right to report any error you find to a credit reporting company in writing. They must then investigate your inquiry unless they can show that your request is frivolous. They also must forward any pertinent data you supply to the organization that gave them the initial information. The organization is then required to perform its own investigation and report back. If the organization finds that it provided inaccurate information, it must send a correction to all three major credit reporting companies. When the investigation is done, the credit reporting company has to provide you with written results and a free copy of your report if the dispute led to a change. If the investigation doesn't resolve the issue in your favor, you can still ask that a statement of the dispute be included in your file and in future credit reports. Now, let's turn our attention to credit scores. A credit score is a numerical snapshot derived from information in your credit file. Credit scores rely on complex mathematical models and are used by lenders to help determine whether a person qualifies for a particular credit card, loan, or service. A credit score estimates the risk a company will incur by lending you money or providing you with a service. There are many types of credit scores, and each has its own method for computing how financially viable you are. The most commonly used scoring system is known as FICO because it was developed by Fair Isaac Corporation. This is what lenders usually mean when they talk about your score. FICO scores range from 300 to 850, and the higher the score, the better. A FICO score of 700 or above is considered an acceptable score by most lenders because it represents good financial health. A score of 600 or below is generally viewed as risky and may cause lenders to reject your application or charge a higher rate of interest. So how does FICO determine your score? Several factors play a role in how it's calculated. To start, your payment history carries the most weight. It accounts for 35% of your score. This makes sense given the primary reason a lender wants to see the score is to find out if and how promptly you pay your bills. 30% of your score is based on your outstanding debts. How much do you owe on home and car loans? How many credit cards do you have, and are they charged to the limit? The more credit cards you possess that are charged to the max, the lower your score will be. 15% of your score is based on the length of time you've had credit. Generally, the longer you've used credit, the more it counts in your favor because it provides more information on which to base an accurate prediction. 10% of your score is based on the types of credit you currently hold, such as credit cards, retail accounts, and installment loans. The more types of credit you've responsibly used, the better off you'll be. Finally, another 10% of your score is based on the age of your individual credit accounts. The more new accounts you have and the more hard pull inquiries that have been made by lenders in a given year, the lower your score will be. If you want to improve your credit score, here are some things that you can do. First, regularly pay your bills on time so that you develop and maintain a positive account history. Making partial or late payments or letting bills go to collection can really hurt. When you establish credit, make sure it's listed in your name. Only apply for and open new lines of credit when you truly need them, and avoid co-signing for others. Likewise, refrain from closing old accounts all at once. Routinely review your accounts and credit reports and promptly dispute any inaccurate information you find there. Also, take precautions to avoid falling prey to identity theft. If someone does open a fraudulent account in your name, immediately contact the account holder and request that a fraud alert be placed on your credit report. If you are currently considered a bad credit risk, the best thing you can do is pay your bills on time and pay down your credit card balances as soon as possible. If you need outside help doing this, consider consulting a reputable nonprofit credit counseling service. Don't hire a credit repair company. Many of these organizations make big promises and charge a hefty fee. If the negative information on your credit report is true, they cannot have it removed. And in most cases, you can perform the very same services yourself for free. In closing, the more you know about credit, the better equipped you are to maintain and improve your financial standing. Knowledge, effort, and self-discipline are your most powerful personal finance tools.